You've always been told the United States runs on taxes, trade, and growth. But that's only half the story. The real engine that powers America isn't productivity. It's debt. Not the kind you rack up on a credit card, but the kind the government creates from nothing and promises to repay with money that doesn't yet exist. This is the story of how the United States mastered the bond trick, how it built an empire out of IS and learned to buy its own debt without hesitation. When Washington spends more than it collects, where does the extra cash come from? There's no national savings account waiting to be tapped. Instead, the Treasury issues bonds, promises to repay later with interest. Investors buy them believing they're the safest assets on earth. But here's the twist. The biggest buyer isn't China or Japan. It's America itself through its central bank, the Federal Reserve. The U.S. has turned borrowing into a self-financing feedback loop. To understand how it started, we rewind to 1913. That's when the Federal Reserve was born, right before World War I. Back then, every dollar was tied to gold. You could exchange paper money for a fixed weight of metal, limiting how much the government could print. But war changed everything. The U.S. needed to arm soldiers, build ships, and fund allies. Gold couldn't cover it, so it issued bonds and the Fed began buying them, creating new dollars to pay for those bonds. Those dollars then funded the war effort. When the fighting ended, the habit stayed. Debt had become the hidden weapon of American power. Here's how the trick works. In simple terms, the Treasury issues bonds. Investors buy them. The Fed then buys those bonds from investors, paying with freshly created money. That money flows back into the economy, fueling credit and liquidity. On paper, everything looks normal. But in reality, the government is borrowing from itself. The left hand writes the IU, the right hand accepts as assets. This loop didn't always run at today's scale. During the 1940s, wartime borrowing reached record levels. The Fed stepped in to keep interest rates low so the government could keep borrowing cheaply. After the war, inflation surged. The Fed and Treasury struck a deal. The central bank would remain independent, but ready to intervene whenever crisis struck. That agreement became the foundation of modern monetary control. Fast forward to 1971. President Nixon severed the final link between the dollar and gold. From that moment, the dollar was backed only by faith. The government could borrow or print as much as it wanted. The bond market exploded. Bonds were no longer promises to pay in gold. They were promises to pay in more dollars, which the government could simply create. Debt lost its ceiling. The Fed gained dominance. Through the 1980s and 1990s, this bond-based system quietly became the skeleton of global finance. Every bank, every country, every investor relied on us treasuries as their foundation. Everyone trusted America to pay its debts, and that trust became the secret fuel of empire. But trust breeds temptation. By 2008, US debt surpassed $10 trillion. Then came the financial crisis. The housing market collapsed, banks froze, and the Fed unleashed its new magic trick, quantitative easing, or QE. It began buying trillions of dollars worth of government bonds with newly created money. Bond prices soared. Interest rates plunged. Borrowing got cheaper. The economy recovered, at least temporarily. But QE also rewired the system. Each slowdown brought more bond buying, more money creation, more dependence. Debt stopped being a burden. It became policy. Today, US debt exceeds around $37 trillion. Interest payments alone top $1 trillion a year. Yet, every bond auction still finds buyers because the Fed guarantees it. So, why would a nation buy its own debt? It sounds absurd, like lending money to yourself. But the trick lies in perception. To the public, bonds are savings instruments. To the Fed, they are tools of control. By creating demand for bonds, the Fed manipulates interest rates. Low rates make borrowing cheaper. Cheap borrowing fuels spending and growth, at least on the surface. It's a financial illusion, like pulling yourself upward by your own shoelaces. This system also gives the US global leverage. Foreign nations seeking safety for their reserves buy American bonds. Each purchase strengthens the dollar. Each dollar spent abroad eventually returns to Treasury markets. That's why the US can run deficits year after year without losing credibility. The dollar isn't just America's currency. It has the world as money. But every trick carries a cost. By buying its own debt, the Fed's balance sheet has ballooned from under $1 trillion in 2007 to over $8 trillion today. When rates rise, those bond values drop, leaving massive paper losses. Meanwhile, the Treasury must issue even more debt to cover growing interest expenses. It's a spiral that looks stable only because everyone keeps believing in it. Confidence, not cash, holds the system together. That's why every word from the Fed chair can move markets. A whisper of tightening and yield spike. A hint of easing and markets soar. The illusion of control depends entirely on trust. We've seen cracks before, like 2013's taper tantrum, when a minor hint of policy change sent global markets reeling, or 2020 when the pandemic hit and the Fed flooded markets with fresh liquidity. Each rescue made withdrawal harder. Each intervention deepened the addiction. Once an economy learns to live on self-financed debt, going sober becomes dangerous. The question now is simple but unsettling. How long can this trick last? Can a nation keep buying its own promises forever? Or does every illusion eventually run out of magic? Because the bond trick doesn't just finance spending. It decides who wins and who loses. When the Fed buys bonds, new money flows first to banks and investors. They use it to buy stocks, property, and commodities before prices rise. Ordinary people feel inflation later when those prices have already climbed. The bond trick quietly transfers wealth upward. It ties Wall Street and Washington in a self-serving alliance. The Treasury borrows, banks broker the bonds, and the Fed buys them back, injecting liquidity that keeps markets soaring while the public pays higher prices. Every crisis follows the same pattern. In 2008, banks collapsed. The Fed rescued them with bond purchases. In 2020, the pandemic froze the world. More bonds, more money, more bailouts. Each round lifted asset prices and widened inequality. By 2021, us billionaires had added over $2 trillion in wealth. Meanwhile, everyday workers faced higher rents, food costs, and medical bills. The system stayed afloat, but tilted further. Bond buying also reshapes politics. In a normal democracy, debt should face limits either from taxpayers or voters. But when borrowing feels painless, restraint disappears. The bond trick lets politicians spend freely without immediate backlash. Wars, programs, subsidies, all charged to tomorrow. As the Fed absorbs the debt, the real cost hides in slow-motion inflation. New money enters through banks before reaching workers. The wealthy see asset gains first. Wages lag behind. Over decades, this compounds inequality until debt becomes the economy's foundation. In 1980, US debt was under $1 trillion. By 2000, it hit about $5 trillion. After 2008, it doubled again. Now it exceeds total US GDP. Why hasn't the system collapsed? Because America borrows in its own currency. It can always pay by printing more dollars, but that safety breeds complacency. If foreign investors lose faith, they'll demand higher yields. Higher yields mean higher interest costs, forcing more borrowing. The treadmill speeds up. China once held over $1 trillion in treasuries. Japan still holds about the same, but both have been quietly reducing their exposure. Domestic buyers, led by the Fed and us institutions, now carry more of the load. When the Fed pauses its buying, markets stumble. When it resumes, rallies return. The global economy reacts like a patient to medication, miss a dose, and symptoms reappear. This dependence makes every move by the Fed a geopolitical event. When yields climb, mortgage rates rise, housing slows, and stocks tumble until the Fed steps in to buy again. Prices stabilize but drift further from reality. A house that once cost $300,000 now sells for $600,000. Not because materials double, but because cheap credit inflated demand. When money is free, everything else looks expensive. This credit-driven world breeds moral hazard. Banks expect rescues. Corporations expect bailouts. Governments expect the Fed to clean up fiscal messes. Each expectation grows with every intervention. The system's health is no longer measured by productivity or innovation, but by how much debt it can absorb. Critics say the bond trick has turned capitalism into managed finance. Market signals, interest rates, bond yields, and risk premiums no longer reflect real conditions. They reflect central bank policy. And when price discovery dies, zombie firms survive, innovation stalls, and capital gets trapped in unproductive corners of the economy. The distortion doesn't stop at us borders. Emerging markets peg to the dollar or hoard treasuries as reserves. When the Fed prints, global liquidity floods in. When it tightens, money rushes out, crashing weaker economies. From Latin America's 1980s debt crisis to the 2013 taper tantrum, US policy ripples worldwide. Treasuries are the global anchor, and when the anchor shifts, every ship sways. Domestically, every Fed decision becomes political theater. High rates slow housing and jobs. Low rates inflate markets. Presidents pressure the Fed for cheap money before elections. Investors bet on the central bank's mood, not fundamentals. Meanwhile, the public debate stays shallow, arguing about debt ceilings that always rise. Default is unthinkable, so the trick continues, each round larger than the last. Some economists defend it as necessary, others call it unsustainable. The truth lies somewhere in between. The bond trick keeps the machine running but weakens its foundations. You can't outborrow your growth forever. Eventually, interest outpaces income and new debt merely pays old interest. That's when the trick turns into a trap. Today, US interest costs exceed $1 trillion a year, more than national defense. Yet cutting spending or raising taxes risks recession. So the easy path is chosen again. Issue more bonds, let the Fed buy them, and pretend it's fine. The longer the illusion runs, the harder the landing becomes. Still, the bond trick gave America more than a funding tool. It built a quiet empire. Every country that trades in dollars, saves in treasuries, or settles oil and greenbacks sustains that system. The U.S. doesn't need colonies. It has the bond market. When foreign central banks buy treasuries, they finance American spending. From military bases to consumer imports, it's a modern form of tribute paid in trust. But cracks are forming. Nations are seeking escape routes. China pushes the yuan in trade. Russia turns to gold and regional currencies. The BRICS talk of a shared reserve asset. None have dethroned the dollar yet, but the intent is clear. The world wants options because us monetary policy exports instability. When the Fed prints, inflation spreads. When it tightens, liquidity vanishes. For decades, the world accepted the cost, believing us bonds were safe. That faith is fading. Political gridlock over the debt ceiling. Credit downgrades and weaponized sanctions all signal risk. Every time Washington freezes reserves or cuts nations off from SWIFT, others take note. You can't rely on a system that might turn against you. That's why countries are stockpiling gold and reducing dollar exposure. At home, the bond trick reshapes public expectations. Debt no longer signals danger. It feels normal. Every crisis brings more borrowing. Every rescue adds trillions. Politicians promise spending, confident the Fed will smooth the path. Fiscal rules sound old-fashioned in an era of limitless credit. Inflation becomes the only visible limit, the quiet tax that erodes savings while the government repays old debt in cheaper dollars. Those who understand this move their wealth into assets, real estate, stocks, commodities. Those who don't watch their savings shrink. Even the safest asset can turn toxic when policy shifts. In 2023, several regional banks failed as rising yields crushed their bond portfolios. Some call this financial repression, keeping rates below inflation to manage debt costs. It transfers wealth from savers to debtors, from the public to the state. It worked after World War II when populations were young and growth was strong. Today, with aging societies and slower productivity, it's far riskier. What happens next depends on one fragile variable: belief. As long as the world believes us bonds are safe, the trick holds. If that belief falters, rates surge, borrowing costs spiral, and the illusion breaks. When that day comes, the Fed faces an impossible choice. Print more to save the market and fuel inflation, or step back and let yields soar, risking collapse. Either way, the cost arrives. Because every trick eventually meets its limit. The bond trick built the modern world, its wealth, its markets, its comforts. But it also built a tower balanced on promises. And every promise lasts only as long as people believe in it. Confidence builds slowly and collapses fast. The lesson isn't panic, it's awareness. Understand the trick, and you understand the system we all live in.